Today I'm gonna show you 7 practical steps for beginners so you can start investing in stocks from today. In fact, these are the same exact steps Stephen used to make $1 million stock portfolio. After the end of this video, you will be able to know what you shouldn't do as a beginner investor. Hey guys, I'm Jahangir, and in this video I'm gonna show you the step-by-step action plan for investing in stocks, including lots of real-life case studies and examples. Stay tuned. Investing is a way to set aside money while you are busy with life and have that money work for you so that you can fully reap the rewards of your labor in the future. Investing is a means to a happier ending. The goal of investing is to put your money to work in one or more types of investment vehicles in the hopes of growing your money over time. Let's say that you have $1,000 set aside and you are ready to enter the world of investing. Or maybe you only have $10 extra a week and you'd like to get into investing. In this video, I'll walk you through getting started as an investor and show you how to maximize your returns while minimizing your cost. Before getting started, let me clear the basic concept about investing in stock. What an inflation is. Inflation is an increase in prices over a period of time. As prices increase, the buying power of each dollar decreases. To explain this simply, bread is more expensive now than it was back in 1930. All investors look for investment that will either keep pace with or outpace inflation in order to maintain their purchasing power. One of the best comparisons I have ever had is that inflation is like having termites in your house. Day by day, it goes unnoticed. The real damage is done over a long period of time. What a stock is. Step 1 in learning how to get into investing in stocks is to understand what a stock is. A stock is a piece of ownership in a company which is listed on a public stock exchange. The total number of shares outstanding is publicly available for everyone to see. Suppose there are 100,000 shares of company ABC and you own 100 shares. This means you own 0.1% of the company. Congratulations! If the company is sold, your portion of the total proceeds will be 0.1%. How to make money? When it comes to investing in the stock market, there are 2 different ways you can make money. The first way you can make money is through asset appreciation. You purchase a stock and hopefully sell it at a higher price in the future. It is important to remember that share prices can be completely erratic and you should always invest in a company you fully understand. Warren Buffett invests in simple businesses like Kraft Heinz, American Express and Coca-Cola. The second way that you can make money in the stock market is through dividends. Companies can decide to share a portion of their earnings with shareholders through dividends. These dividends are typically paid on quarterly basis, but in some instances, companies pay annual, semi-annual or quarterly dividends. How much return should you expect? On average, the stock market has averaged a return of 8 to 10% per year. This is the average, meaning you will not experience this every single year. In a bull market, a time when the prices of stocks is rising, you could see returns of 15% per year or more. In a bear market, a time when the prices of stocks is falling, you could see a 20% loss or more. What is compound interest? Investing even very small amounts can reap big rewards. Even if you only have a few dollars to spare, your money will grow with compound interest. Einstein called this the 8th wonder of the world for a reason. It does not take a Harvard degree to understand the power of compound interest over time. If you earn a 10% interest annually, you double your money in 7 years, triple it in 12 years, quadruple it in 15 years, 10 times it in 25 years, 50 times it in 41 years, and 100 times it in 49 years. I encourage you to play around with the compound interest calculator if you haven't yet. Check out the video description for more information. Step number 1. Start investing as early as possible. I read some books on finances and I just learned some basics about the investing, and I realized the most important thing is to start as early as possible. Because the earlier that you have started, then the more beneficial it's gonna be later in your life. Because then you can take the advantage of compound interest, which Einstein said is the 8th wonder of the world. Step number 2. Pay off high interest debt. The most common debt people have is credit card debt. As good as returns from the stock market can be, they are never going to top the interest rates of your credit cards. Since this is unsecured debt, it typically has the highest interest rate. It is not uncommon for people to have a 20% or higher interest rate on a credit card. Step number 3. Setting up an emergency fund. The next step is to build up an emergency fund. Anything from having a car breakdown to losing your job can leave you in unexpectedly dire financial straits. If your only remedy is to sell your stock investment, you might end up taking a loss right before the stock makes a big gain, depending on the timing of the stock market and your emergency. A general rule for thumb for this is that this should be enough to cover all of your expenses for the next 6 months. Pretend you lost your job or main source of income tomorrow. How long would you be able to sustain yourself before you needed to grab your credit card? If the answer is anything less than 6 months, you need to build up your cash cushion. So, if your expenses every month is $3,000, then you need to put aside at least $18,000. This money should be sitting in a liquid account, like a checking account or money market account. This money should not be invested. Step number 4. Handle basics first. Before making your first investment, take the time to learn the basics about the stock market and the individual securities composing the market. Understand the definitions of metrics such as the P/E ratio, earnings per share (EPS), return on equity (ROE), and the compound annual growth rate (CAGR). Knowledge and risk tolerance are linked. As Warren Buffett said, risk comes from not knowing what you are doing. How much should you invest? Saving money and investing it are closely connected. In order to invest money, you first have to save some up. That will take a lot less time than you think. You can do it in very small steps. If you've never been a saver, you can start by putting away just $10 per week. That may not seem like a lot, but over the course of a year, it comes to over $500. The amount of money you should invest in stocks is entirely dependent on your own personal situation. The most important financial decision of your life, which is that you are gonna take a percentage of what you make, and I recommend 10% at minimum. Take 10% and you are gonna put that aside and invest this regularly. The minimum amount to invest in share market is very low thanks to a slew of brokers allowing customers to buy fractional shares. Many well-known stocks like Amazon and Alphabet may be out of reach for all but the richest investors. Online e-commerce giant Amazon stock trades north of $1,500 per share, but now investors can buy half a share or even 1/10 of a share. So, how much money do you need to invest in shares? Technically, it would be possible to start with as little as $10. Yes, $10. When should I invest in the stock market? Today is the absolute best day to invest in stocks. Before you consider investing, make sure you have paid down any and all high-interest debt. You should only start investing in stocks after you have paid off your high-interest debt and build up an emergency fund with about 6 months income. Step number 5. Opening an investment account. In order to invest in stocks, you will need to open a brokerage account. Such accounts are offered by brokers such as E-Trade, TD Ameritrade, Interactive Brokers, and many more. Accounts can be opened in 10 minutes if you have a social security or social insurance number, a home address, and an employer's address. Even if in the case of self-employed, your bedroom is your office and casual Friday means pants discouraged. Brokers enable you to easily buy and sell shares in any public company, but they do charge a fee for their services. You will first need to choose the type of account that fits you best. After you decide which account is best for you, it's time to compare the features of different brokers' offerings. Some are better for active investors, others are specifically geared towards beginners. If you want to participate in the stock market without picking individual stocks or building a portfolio from scratch, check out the platform Betterment. This is a robo-advisor that will build you a portfolio from scratch based on your age, time horizon, risk tolerance, and goal. With a robo-advisor, you can make your money work while you play. In most cases, Betterment is a great option for beginners because they do not have any minimum account balance to get started. Robinhood allows you to buy specific stocks without charging a per trade commission, making it a great option for beginning investors. Step number 6. Your first investment. For most investors, especially beginners, your best option is to invest in low-fee index funds. In fact, Warren Buffett recommends that people simply invest in a low-fee S&P 500 index fund. Did you know that if you had invested $10,000 in the S&P 500 index 50 years ago, you'd have generated well over $1 million today? Believe it or not, this is a major difference that separates the wealthy from the poor today. If you are investing for a far-off goal like retirement, you should be invested primarily in stocks. I recommend you do that through mutual funds. On the other hand, if you are investing for a short-term goal less than 5 years, you likely don't want to be invested in stocks at all. It is possible to beat the market and you can learn a lot by investing in individual stocks. However, if you are brand new to investing, you should start with an index fund. It is in your best interest to build your tolerance for risk and your understanding about the stock market before you begin to hold individual stocks. If you are looking to invest in individual stocks as a beginner, you should familiarize yourself with blue chip stocks. This is because they typically represent the least amount of risk as they are highly liquid, well-established businesses with a history of delivering steady returns, which is why they are known as blue chip shares. Buy low, sell high. There are a number of core investing principles that you should know before you begin investing in the stock market. Here are the cardinal rules for sensible investing that will help you stay out of trouble. Buy low, sell high. This is the most important investing principle, yet so few actually practice this. The stock market is a pendulum. A man by the name of Benjamin Graham once said that the market is a pendulum, forever swinging between optimism and pessimism. Warren Buffett learned a lot from Benjamin Graham. For example, Buffett has said that you should be greedy when others are fearful and fearful when others are greedy. If you hear everyone talking about a hot stock, it is probably time to sell it. If you believe the stock has become overvalued, you might want to consider selling of a portion or all. One of my favorite moves in this situation is to sell Anna to cover my initial investment and let the profits ride. This is called playing on house money. Ignore the noise. When it comes to investing, noise is everywhere. There is always a line of people waiting to give you their opinion regardless of whether or not you wanted to hear it. To some extent, you can control the noise. Most of it is coming from the news outlets. Keep track of the major company announcements, quarterly earnings reports, and annual reports. Beyond that, the rest is just noise. Publicly traded companies are required to report the earnings to shareholders on a quarterly basis. Step number 7. Don't put all your eggs in one basket. It simply means that you probably don't want to have all of your money in one company or even one industry. Diversification will help you minimize your risk that comes from a single company going bankrupt or even an industry getting in trouble. Diversification is considered to be the only free lunch in investing. As an investor, you are a part owner of this company and you should be staying up to date on what is going on with the company. If you are looking to build a well-diversified portfolio with a small amount of money, take a look at M1 Finance. This brokerage account allows you to invest fractional shares in a company. Stocks are a long-term investment. Warren Buffett believes that you should have a minimum time horizon of 5 years when investing in a stock. Investing with a time horizon of less than 5 years is speculation or gambling. As a long-term investor, you should be more interested in the earnings reports and earnings call. I encourage you to listen in on earnings reports as a well-informed investor. Believe it or not, there is a significant tax advantage associated with being a long-term investor. The last thing I'll say on this, investing is a long-term game. So you shouldn't invest money you might need in the short term. That includes a cash cushion for emergencies. If you like this video, make sure to subscribe to my YouTube channel right now. Just click on the subscribe button below this video. And if you want exclusive techniques of growing your income and business that I only share with subscribers, head over to Invest Time Grow Online YouTube channel and subscribe for the latest videos. It's free. Now I wanna turn it over to you. Which technique from today's videos are you gonna try first? Are you gonna try pay off high interest debt, or do you wanna use setting up an emergency fund? Let me know by leaving a comment below right now.